Hi there, I'm Jesse, and this is a presentation on mortgage in Switzerland, what I wish I knew. So, not long ago, my wife and I bought this property in Ticino, Switzerland, and we had to get a mortgage to do so. And so, in that process of getting that mortgage, there was a lot of information gathering and piecing together, and it was a bit confusing. And I just wanted to create a resource for anybody that's in a similar situation where the most important insights are in one place. So, to start, just a definition that goes a bit deeper than you typically might hear. A mortgage is a loan made by a bank with a property as a collateral, which means that they reserve the right to seize ownership of that property if you do not pay back the loan. And interest rates are what you pay the bank, and they are typically proportional to the missed opportunity cost that the bank has in not leaving the money with the central bank. So every bank has an account with the central bank, and they can get interest on that account, on the money that they put on that account. So if they consider instead giving that money to you in form of a mortgage, that needs to be more interesting to them. So they need to earn more than they would have with the central bank for them to be interested. And that's how the central bank actually ends up influencing the interest rates for mortgages. If you speak to anybody at a bank or any mortgage advisor in Switzerland, they will all draw this diagram for you. So you've got a house here, and that house needs to be funded. And in this case, it's funded by a loan of 80%. So this is the mortgage, and 20% equity, value, own capital, all different names for the same thing, money you bring in yourself. Within those two chunks, you can zoom in even further. And so that 80% mortgage is actually split up into two mortgages. They're called the first and second mortgage. And the first mortgage is 85% of the total of the mortgage, and the second mortgage is 15% of the total of the mortgage. Now, that second mortgage needs to be paid back within 15 years. That's called amortization. So within 15 years, you need to pay back the 15% of your mortgage. The remaining 85%, you don't need to pay back at all. You can just keep that until you die. Which sounded very strange to me in the beginning, but for the bank, they're happy as long as you keep paying interest. At some point, you'll have paid so much interest that you'll be paying more than the house than you paid for the house to begin with. So they've set up the interest rates that makes sense for them, and many people never end up paying back their mortgages. And so what happens is when they die, their offspring might sell the house and get back the money that way, or the bank gets back the money that way. So then, in terms of the money you bring back yourself, there's two categories within that as well. So you don't need to bring in everything cash yourself. Up to half of that you can bring in your own second or third pillar pension. Second pillar is the mandatory pension that you pay when you're employed in Switzerland or self-employed, and the third pillar is the voluntary pension scheme that you can set up, which is a good idea to look into if you've not done that already. And so you can use those to fill in the money that you need to bring in yourself. So there's two important indicators that the market looks at because the Swiss regulatory authority has stipulated that these are requirements, and that those are affordability and loan to value ratio. So we're going to look at those by looking at two popular mortgage calculators online. So one is the Comparis one. We'll look at that one first. And so Comparis here has the same diagram, the house. And here you see the 20%, so this is the 22% in this case, this is the own cash, and the 78%, this is the loan, the mortgage. And so the first indicator that the market or the banks will look at is the ratio between these two. So this can never exceed 80 to 20%. That means that the loan can never be more than 80%. So if we were to decrease the deposit. So we're going to decrease that 22%. At some point, we're going to sink below 20%, you see, and it turns orange here and it says insufficient. So that means that the loan to value ratio is insufficient. The second parameter that they look at is the affordability, and this goes into the monthly costs. And that one is better understood by looking at a different calculator, and this is the UBS calculator. So if we look at the UBS calculator, there's a purchase price of the property 800,000, which is going to go with the defaults, because what we're interested in here is the breakdown of the monthly costs. And here they calculate the monthly costs. They need to assume an interest rate. And in my experience, they usually use 5 because that's the historic average. And also at the day of this recording, it's around 2% in the market. But they like to be conservative for this calculation, so they'll calculate a bit higher. And then we get an interest rate, which is the biggest chunk of your monthly costs, it's 2,500. We have one line item which is amortization, which is 370 in this case, and we have incidental expenses, which is basically maintenance and costs of the house, which they calculate as 1% of the purchase price of the house. So this is the calculation that's stipulated by the regulatory authority, and this is how they calculate the affordability by taking this number, so the monthly costs, and dividing that by your monthly income. So this amount cannot exceed 1/3 of your income. And so going back to the compares calculator, we've got the affordability here. So we see we're in the okay now. But if we were to say, okay, our income is actually decreasing, at some point that affordability becomes not okay. So there's something weird about the affordability where it actually goes up, which is bad or something like that. But all you need to know is that in this case, it's not okay. The calculator will tell you. So it's these two parameters, the affordability and the loan to value ratio, that are the first things that the bank will look at. In terms of mortgage advisors, so I'm from the Netherlands, and in the Netherlands I'm used to people, when they're interested in getting a mortgage, they go find a mortgage advisor, they talk to them, the mortgage advisor helps them navigate the market and pulls in some quotes from different banks, and that's how they go about things. This doesn't seem very common in Switzerland. I've not seen many different mortgage advisors. There seem to be one or two bigger companies. Excuse me. Some names that come to mind are Money Park and Hippo House. We ended up working with Money Park. I will link to my review of Money Park in the video description below. It's not glowing positive. It's definitely also not negative. We were happy with the offer that we got through Money Park, but we were not completely blown away. Let me put it that way. So it's more of a neutral review, but it's definitely some interesting details there. So have a look at that if you're interested. Interest rates. So interest rate is the one way of thinking about it, is the price that you pay for borrowing money. And when I just started researching mortgages, I was obsessed by trying to find sort of the bargain configuration, interest rate configuration, like where's the gap in the market. But then a friend of mine who has more experience with this than I do, he assured me, listen, it's all priced in. And what that means is that there's no need to try and outsmart the quants at UBS. They've priced in the different risks. So just look at the different quotes that you get, and then you'll see that they're pretty much converged on the same things, and you don't have to go looking for the gap in the market. Instead, you can, if you want, you can get a feeling for the interest rates of the Swiss National Bank, because this is one of the factors that determines the interest rates that the Swiss banks will be able to offer you. So you can see that on this link. You can see as of this recording, it just went down a little bit. And you can also look at the European Central Bank at those rates. You see that they're a bit higher, but they've also just gone down. And so I know that we ended up getting a mortgage through UBS, and they mentioned that they were mainly looking at at these rates, the European rates, to determine their interest rate. And then lastly, if you want to compare the different interest rates, vermögencentrum.ch, they've got the best overview of the different rates. So you can see variable 1 to 5, 10 years. You can sort and look at the best deal. One caveat about this table, you might not be able to actually get this rate from the bank. It's more of a qualitative comparison, or a relative comparison, I should say, because if your situation is a bit riskier than the normal, they won't be able to give you the lowest of the low. So that's just for you to know, to take into consideration. Different types of mortgages. So there's three main types of mortgages. You've got a fixed rate mortgage. This is the most common, where you just fix the interest rate for X amount of years. People like this because there's no surprises. You pay the same monthly cost as you do throughout the fixed period. Then there's two types of mortgages where the interest rates vary, so the monthly cost will vary. There's the variable rate mortgage, which I believe is less common. The bank can change the fees anytime that they wish. And it turns out it's good if you want to pay back anytime you want without incurring a big penalty. And then there's the Saron mortgage, which is an interest rate where it's not the bank that determines the value, but it does change. It's the market that determines the value. And these some people like because they're, although they can go up and down, and you might be paying much more one month than the other, they're typically cheaper than fixed rate mortgages. If you take a long time scale, let's say 10 years, but there's a bit more risk involved. So if you choose to use your second or third pillar pension in that 20% that we looked at here, if you choose to do that, there's two ways. One is withdrawing, where you take those funds out of your pension fund. You typically, you might pay a fee for that to your pension fund, and you'll pay a tax to the government for doing that, but then you can use that money to pay into your mortgage, or to construct your mortgage. Or the alternative is to pledge it. So that's where you simply sign a document to the bank, where you say, if I default on my loan to the bank can take my pension, which sounds a bit scary, but it turns out that after a couple of years of amortizing, you will have paid enough into your mortgage that the bank can release the pledge. So typically it gets released after a couple of years. So looking at an overview of the benefits and drawbacks of using your second and third pillar. Withdrawing, you can potentially invest the money. If you have enough liquidity to pay for the house, you still have the right to withdraw the money from your pension, and you can invest it elsewhere and potentially earn a higher yield than you can at your pension fund. The drawback is that you lose the opportunity to accrue yield with the pension fund, which is admittedly a lower yield, but they're supposed to be low risk. You have to pay tax on the money you withdraw, and you're reducing your pension savings. And it should go without saying that the benefit in both of these cases, withdrawing and pledging, is that you are able to use that money in the first place. Pledging then has some benefits. Your money continues to accrue yield in your pension fund because you do not remove it, you just keep it with your pension fund. The bank can offer you a mortgage at a higher 90-10 loan to value ratio. So because you're not actually taking the money and using it as that 20% cash, you're simply telling the bank, listen, I've got that money here, you can take it if shit hits the fan. So the actual value that you're bringing in is just the 10, it's just the cash part. And so the 90-10 loan to value ratio is something the bank needs to agree with, and they do if you make the pledge. Another benefit is that you don't pay any tax on the money that you pledge. The drawbacks are that you're stuck with a low yield of your pension fund. The higher loan means that you have a higher interest payments, and your money only accounts for 90% of its value. So the bank only counts your money. So that if you've got 100K, it'll count as 90 to account for the higher risk that is involved. So amortization, this is paying back the mortgage. So there's the direct amortization where you just simply pay back you pay down your loan. And there's indirect amortization where instead of paying down your loan, you pay into a fund and that fund gets invested. And then you sign a document telling the bank that when you retire, this fund is expected to be some size, and they're able to take the full value of that amount that needs to be amortized. So that's that 15%. They're allowed to take that out of there. Comparing these, the direct amortization, the benefits is that your outstanding debt decreases, so your interest payments decrease. The drawback is that your payments go directly towards paying down the loan, and there's no possibility of accruing any yield. In terms of indirect, your amortized funds continue to accrue a yield, and the drawback is that the yield may become negative, so it may take longer to pay back your mortgage. And another drawback is that your outstanding debt doesn't decrease, so your interest payments don't either. And the last slide here is an overview of our mortgage. So our the total amount that we needed to spend was $642,000. The property price was $570,000. We also got a mortgage for the renovations of $72,000. So the 80% of that is $577,000. Equity we needed to bring in was $128,400. We brought in 11.5% cash and 8.5% second pillar. That's because we just didn't have more than that in our second pillars. And we chose for indirect amortization through Helvetia investment insurance, and then 50% of that is being invested in UBS ETF fund, Equities Global Passive, and 50% in another UBS ETF fund, Equities Switzerland Passive. So that's an overview of, I think, the important things that we discovered during this process. Let us know, or let me know, what you are struggling with. If this was helpful, leave a thumbs up, leave a comment. I'll try to reply to all of them, and good luck in your search, and hope to hear from you.